Investors, inflation has once again come down. We are at 6.5% inflation, another battle won, but the war is far from over. And a matter of fact, I'm still here sharing for all of us to be prepared for the worst, but plan for the best. And how exactly do we do that? Well, value in dividend investing is the ideal. For those of you who are new here, I'm Ari, and welcome to the channel where we're talking strictly about value in dividend stock opportunities. Now, as for today's video, I have a quick portfolio update for you, but more importantly, a pressing macro market overview followed by 5 dividend stocks to put onto your radar, add to your watch list, and truly consider as we ebb and flow our way further into 2023. But before we dive in, I'm here asking for your help. With just one click of a thumbs up button, you can gift a YouTuber with a smile. But hear me now, if you're feeling like you could do even more and you haven't already joined me on this journey, with just 2 clicks, one on that thumbs up button and the other on that subscribe button, you can gift that very same YouTuber with an abundance worth of gratitude. Now, investors, let's go ahead and get right to it. So thanks to all of the momentum building up in the market, my account jumped to $104,620.05. But what's most important for you to understand is the rationale behind all of this momentum. So let's chat about this economic backdrop of ours. Not too long ago, we had a non-farm payroll report released, which depicted that the United States added roughly 223,000 jobs to the US economy. Now, economists expected that report to come in around 200,000 jobs. Ultimately, this means that our labor market is still strong, and because the actual count didn't come in exponentially higher than the expected, the news was favored by the market. Now, just the other week, on Tuesday, Jerome Powell spoke out at a conference, sharing that the Federal Reserve will stay in their lane and not involve themselves at all with anything other than monetary policy. And secondly, he shared that the Federal Reserve is prepared to slow the rate of interest rate hikes. Now, this news spurred the market even more, but the problem was and is, in my opinion, hope and optimism was built in the market that the Federal Reserve was going to pause or pivot with rate hikes, which is not necessarily the case, nor what Powell even said. Now, we're likely going to see smaller interest rate hikes well into 2023, given the projections of that terminal rate coming to 5 to 5.1%. Now, this leads me to talking about inflation, where the latest consumer price index report came out with the latest inflationary reading now at 6.5%, down from 7.1%, which is great, except for the fact that this is not going to stop the Federal Reserve from hiking interest rates just yet, given their goals to get inflation all the way down to 2 to 3%. Now, what does this all really mean? It means that we as investors should remain cautious and invest wisely into companies that can in fact make it through a deep recession, because it's likely going to get worse before it really does get better, and we get that all clear sign that we're going to enter into a bull market. So with all of that out there for us to digest, let's get into these 5 dividend stocks that I am here sharing with you that you should at least add to your watch list, with the first dividend stock of the day being Bill Gates' baby, a leading tech titan that is constantly technologically advancing the world as we know it. It is Microsoft, ticker symbol MSFT. Of course, with every single interest rate hike, tech companies and the alike have been there to take the initial hit, and we see the impact of rate hikes even on such dominant tech leaders, with Microsoft's stock share price down 25% on the year, trading for roughly $235 per share. This is, after all, a $1.75 trillion market capitalized hardware and software leader that will certainly continue to enhance technology and the world as we know it for decades to come. Now, I'm not going to sugarcoat what I truly foresee coming, which is more pain ahead for Microsoft and other growth-oriented tech opportunities like it, given that the Federal Reserve will continue to raise those rates well into 2023. But this is not about a profit in the month or 6 months from now. It is about the long game. And most recently, Microsoft's reported plans of investing $10 billion into what is seen as a revolutionary AI tool known as ChatGPT that has not only generated a lot of shareholder excitement and media buzz, but my respect here for whatever that is worth. Now, at this time, Microsoft is not necessarily at the ripest of PE ratios, with their PE ratio at 24.7, but with a tech gem like Microsoft, I wouldn't expect it to fall below 20, yet that hasn't stopped smart money, the hedge funds, from scoring shares, with the leading hedge fund manager here seriously doubling down on this investment being Bill Gates himself. But as you can see, plenty of other hedge funds with plenty of confidence in Microsoft. As for analysts, We are seeing plenty of upside here forecasted, with over 23% worth of upside, coming to a share price of $290.39 per share. Now, given the time it may take Microsoft to actually recover, what I'm really taking a look at and loving about Microsoft is that dividend of theirs coming in with a dividend yield of 1.13%. Next up, I want to pivot out of the tech sector and into the healthcare sector, given I would consider it to be an ultra safe sector to be invested in. So let's talk about AbbVie, ticker symbol ABBV, which is a massive industry leading pharmaceutical player. And while I'm typically talking about Johnson & Johnson, AbbVie is in fact my runner-up. Now, a lot of investors were troubled with the news of AbbVie's patent protection running out on Humira, the drug that really drove their profits since its introduction to the market. But we can't be mistaken here. AbbVie's ability to deliver through again and again on blockbuster drugs is there. With their current market capitalization at $277.95 billion, they have plenty of firepower. And a matter of fact, as of recent, AbbVie raised their sales outlooks for 2 drugs to more than $17.5 billion come 2025. Now, AbbVie's share price currently is down nominally, nearly 6% just in the past handful of days, trading for around $157 per share with their PE ratio just above 20 at 21.3. I would once again like to make the case that it's worth paying a bit of a premium for some safety. It's not always a bad decision, especially knowing what the months ahead may bring our way, and analysts seeing upside coming AbbVie's way with a share price of $161.17 per share. Now, if that doesn't quite do it for you, we can peek into smart money moves and find comfort in the fact that hedge funds have also found AbbVie to be an attractive investment. However, let's as dividend investors focus on what we're here for when it comes to AbbVie, given their dividend that AbbVie has been shelling out, coming in at 3.39%. Coming to our third dividend stock for today, let's jump right into the financial sector with a dividend stock that I don't think could be more set up to drive shareholders explosive returns upon an economic recovery. We have T. Rowe Price, ticker symbol TROW, which is an investment management firm not only offering funds but account management and other financial services like retirement planning, or even on a larger scale, financial services for institutions. We are talking about a firm that has over $1.34 trillion in assets under management and has been in business since 1937, solidifying quite a name for itself while amassing a whopping $26.88 billion market capitalization. Yet with the vast majority of their assets invested in the stock market, even more specifically invested into opportunities within the NASDAQ, T. Rowe Price has been taking an absolute beating, as we can see that their stock share price is down over 30%, trading for around $120 per share, which is actually up in fact from months ago when it was trading for less than $100 per share. Which is why I have been sharing that an investment into T. Rowe Price may take time to actually rebound, but with an economic recovery, patience is required, and honestly, that patience is a virtue that will pay the biggest dividends, which I'm going to talk about in a second here, because I want you to understand that right now, it is still a solid buy to buy into T. Rowe Price with that PE ratio at 13.9, far below competition out there. And as for smart money, well, it looks like they are playing it smart by way of investing into T. Rowe Price for the longer term. But I think the beauty of this investment is obviously twofold, because that share price will not only likely recover in time, but until it does, shareholders of T. Rowe Price will be collecting on a very solid dividend, with their dividend yield coming in at 4.09%. Now, as for the final 2 dividend stocks, they are both never before mentioned opportunities on this channel in dividend stocks that are paying insanely high dividends that I'm very excited to break down for 2023, with the potential that they actually both have. The first is EOG Resources, ticker symbol EOG, which is an energy company that is engaged in hydrocarbon exploration with a mission to be a significant player in the so-called green revolution by being a low-cost, low-emissions producer of oil and natural gas. Of course, I think we have time to go before a total green revolution is really in full swing, but there is no doubt that the climate concerns are growing, and the companies on the forefront of this initiative will be among the most profitable. As for EOG Resources, we're talking about a $74.51 billion market capitalized Fortune 500 energy leader. And while EOG is actually up on the year, trading for $126 per share, it's nonetheless at a lower PE ratio here of just 10, and moreover, analysts see plenty of upside, over 22% worth of it coming up to a share price of around $155.47 per share, as we see millions being poured in from smart money. However, here's what's really captured my attention when it comes to EOG Resources. It's their dividend, with that dividend yield sitting at 7.29%. And finally, if you were blown away by EOG Resources dividend, just wait for what I have in store for you now. The final dividend stock I'm telling you to add to your watch list is Aris Capital, ticker symbol ARCC, which is a specialty finance company priding themselves on being a one-stop shop to deliver financing needs to private middle market companies across industry verticals. As of this video, Aris Capital is actually the largest business development company by asset size and has built a very reputable name for itself since its inception in 2004, all allowing for their market capitalization to amass to more than $9.82 billion. But with the market conditions as they are, less ventures having been sprouted, and more conservative risks being taken all around, Aris Capital has not seen much upside lately. A matter of fact, they're trading for $19.32 per share, which is roughly 3% off from their share price a year ago of over $20 per share. Now, in my opinion, Aris has some room to run in a flourishing, booming economy, which means an economic turnaround is necessary for Aris Capital to truly flourish. Mind you, that's going to take some time, but if we're here for a strong dividend, they will deliver until then, which is likely why we see hedge fund activity when it comes to Aris Capital, with smart money buying and more so promising upside to come, with analysts forecasting a share price of $21.33 per share, and getting invested now with a PE ratio at a low of 11.3 is not a bad move here. But brace yourself for this dividend coming in at a whopping 10.11%. Now, investors, there you have it, from Microsoft to AbbVie, T. Rowe Price to EOG Resources and Aris Capital, the 5 dividend stocks that I'm here to share that you should add to your watch list and begin your own due diligence on for yourself. But don't forget here to let me know your thoughts once you do by dropping your thoughts in a comment down below. And just before you click off this video, please help me in growing this channel by tapping on that thumbs up button, and if you haven't done so already, subscribing to this channel while you're at it. Now, with all of that said, investors, I will see you all in the next video.